Starting with asset analysis, we're going to walk you through how the fundamental metrics are calculated, as well as discuss historical time periods and why those matter when calculating your returns. In terms of fundamental metrics, we have 5 metrics that we leverage for grading assets in our system. We use expected return, alpha, Sharpe's measure, Trainer's measure, and then of course we have our overall average. And when we started down this path, we weren't sure what would work for this. We actually took a look at 11 different metrics before settling on these 5, and we chose these 5 because they tested the best over time, and some of them you might even know or have some prior familiarity with. Some of the results you can see here, and if this table looks familiar, it's because we also showed it to you in Portfolios 100, and we wanted to bring it up again just as a refresher. In order to understand these metrics, there are a few other measures that you need to know, so we're going to walk you through those as well. The first 2 are beta and R squared, and in order to understand beta, we need to walk you through what a covariance is, and in order to do that, we also need to walk you through variance and standard deviation. And before we can cover Sharpe's measure and Trainer's measure, we need to walk you through the risk-free rate. So taking a look here, these are all of the metrics that we're about to walk you through. Now in terms of the format that most of this is going to be presented in, we really tried to be fairly consistent on how we presented everything. We wanted you to be able to refer back to these materials and easily find what it is you're looking for. At the top we have a definition. Now, this is not necessarily what you're going to find when skimming through finance textbooks. We tried to generalize them as much as possible to make them easier to understand. Now, on the left side, there's a box that has the math formula. Then below that, there's a written out formula. So you can clearly understand the formula above it and what it's trying to tell you to do. In the middle, we have a section with some data in order to provide you with an example. And then on the top right, we summarize that example. And then in the below gray box, we include some basic tips for how to use each metric. Let's get into expected return. Expected return is the average return over a time period. With a lot of these slides, you're going to see 2 math formulas in the upper left, one for analyzing a single record and a second for analyzing a set of records over a time period. Showing you an example, here's the math behind calculating a single return. And from there, a single return goes into a set of returns, and then that set gets analyzed as the group, and you come up with your expected return for that time period. That's why changing the historical time period or the set of returns that you're using will change the outcome for each metric. So in terms of our automated test portfolios, that will change the group of stocks that the computer uses during the selection process, and that's how you end up with different recommendations for each of the different strategies. Now on the right side, we included all of the math written out for the final calculation, and we tried to keep these examples fairly simple so you can understand the basic methods. We don't expect you to be able to pass like an investments exam based on these materials. To sum up expected return, this is just a good measure to help you understand assets and their historical price growth. Sometimes you'll hear comments like historical returns don't guarantee future returns, and that's true. Just because the stock you're checking out has had a good expected return, that doesn't necessarily mean that its expected return is going to be maintained. Things tend to balance out over time, so if the stock has had a really good period, that's not necessarily saying it'll go down, but things do tend to be cyclical, so keep that in mind as you're looking at expected returns for your potential investments. And don't get me wrong, it's a great metric and it's commonly referenced by investors, so it's definitely one that you always want to review and consider. Another foundational metric is variance. And with variance, you're essentially taking your time period return, you're subtracting your expected return, and then you're taking the square root of that. And then for the population, you're taking all of your variances and then dividing them by the total number of records minus 1. So here's an example where you find the variance for a time period. And the biggest thing that you need to take away about variance is that it's an identifier of risk. It can help you understand how much risk is associated with a particular asset, which can help you anticipate asset price fluctuations. Standard deviation is another measurement that helps you understand the risk of an asset, and this is essentially how much the asset is expected to move over one time period. To determine standard deviation, you're taking the variance and taking the square root of it. And then again, doing the same thing for the total population, you just take the variance for the population and you take the square root of it. Now, standard deviation reflects how much a return is expected to vary from one period to the next, and it can help you understand how much your assets move within a normal distribution. For example, as you begin your trading day, if you have a standard deviation of 0.6, that means on any particular day that stock will go up or down 0.6%. Now, the reality is it can go up or down much more than that, but that's what you use this for. If your stock gains 2% in a day and you know your standard deviation is 0.6%, then that means it was an unusual gain. And at that point, you should check the news to see if it was something related to the company or the market that created that return. And knowing that will help you understand what to expect next. And in the reverse of that, say you were to lose 2%, then you would do the same thing. Now, obviously, you're a lot less happy because you lost money, but you should look to understand why the stock experienced the loss so that you can make a determination about what you need to do next. Taking all of this to the next level, let's talk about covariance. Covariance is something that we're going to get a lot more in depth with as we talk about portfolio analysis, because this is something that we leverage for the portfolio grades. And essentially, a covariance is how much risk is created by combining two assets together. To get a covariance, you take the return for the time period and subtract the asset's expected return. Then you do the same thing for your index and you multiply those two elements together. You'll do that for each time period. Then to determine the asset's covariance for the population or the total time period, you do something similar to what you did with variance, where you add up all of the covariances and then divide by the total number of time periods minus 1. So, what does all that mean? Well, essentially what you're trying to understand is how two assets interact with one another and how much risk is associated with combining them. So when we get into portfolio construction, we'll get a little more in depth with variances and show you another example with two assets to help you understand how we leverage them for our portfolio grades. The focus there is which assets are contributing the most risk to your portfolio when you're combining them. Beta is probably one of the most important metrics to understand for stock investing. Beta is essentially a representation of how much your stock is going to move in comparison to the market. If the market produces a 2% return and your beta is a 2, that means your asset is going to have a roughly 4% return. Now that might sound good, but at the same time, when the market goes up, it also comes down. So if the market all of a sudden loses 4%, then you lose 8%. So what this means is that you need to pay attention to beta when selecting your stocks, and an ideal beta is typically close to 1, which just means that the stock returns are proportional to the index. Getting into how beta is calculated, you're taking the overall covariance between the index and your asset, and you're dividing it by the variance of the asset for the time period. So it's how much combined risk do you have for every unit of risk that you're taking on. And you want that to be close to a 1-for-1, because having stocks with high betas will create highly volatile portfolios. So by focusing on stocks with a beta close to 1, essentially you're trying to reproduce a market return or basically create your own index fund using the stocks that you're actually interested in. And by doing that, you're also going to have a portfolio that's fairly stable. And by stable, I just mean that it reflects the market return. Now, it's true that if the market is more volatile, your portfolio will be too. But by staying with stocks with a beta close to 1, you're not taking on any unnecessary risk beyond what you would experience with an index fund. And this is better because you get to invest in the companies that you actually want to own. R-squared is the coefficient of determination. This is a measure that you can use to determine how much of a return can be attributed to a particular index. In other words, it's a measure that you can use to see how much two things are correlated. And correlation is a fun word for me because it means something mathematically, and I hear people use it in business settings all the time fairly loosely. Well, in terms of stock investing, this is important because you want to understand the movements in your portfolio and what are the main contributing factors. If you have a high R-squared, meaning close to 1, then that just means that most of the return for your asset is from the index rather than the asset itself. So in that instance, you might want to pay more attention to what's going on in the market, since the market has more weight in determining the stock's price performance. So getting into how it actually works, you're taking the covariance again, kind of like beta, but this time you're taking the covariance and you're dividing it by the standard deviation of the asset multiplied by the standard deviation of the index. Then you're taking that and you're squaring it. In this particular example, although the data only covers 13 days, you can see that 34.5% of the returns associated with this stock were attributable to the index. And if you have a stock with a high R-squared, it's not necessarily a bad thing. It just means that the vast majority of the returns for the stock can be attributed to the index. Risk-free rate is what should be the minimum acceptable return for your portfolio. This is a rate that's typically based on treasuries, like a 1-month T-bill rate. However, depending on the investor that you talk to, they may use a different benchmark. The 1-month T-bill rate is the most common one used by Wall Street analysts, so that's what we use in our examples. And if you want to know the current 1-month T-bill rate, you can go to the U.S. Treasury Department's website, and they post all of the current treasury rates on there daily. On the screen here, we have a snapshot from early 2023, and you can see the rates at that time. And in this example, the data in this table was from 2021 and during the pandemic, when rates were very close to zero. And I'm showing you this set of rates because it's what we use in our next few examples. But using this screenshot from early 2023, 4.23% would be the minimum acceptable return for your portfolio at that time. And if your portfolio is expected to perform worse than that, then logic would push you towards moving your money into the treasury and out of the low-performing stocks. This is what we mean by it's the minimum acceptable return, because if you can get the return and it's guaranteed through a bond, then why would you accept something less from your stocks? So knowing the current risk-free rate should help you set standards with stock investing and give you some thresholds not to cross when making stock selections. So just because you have an interest in a particular stock, you should always consider the math and if there are better options available. Sharpe's measure is one of the metrics that leverages the risk-free rate. And essentially how it works is you take your expected return for the asset, you subtract your risk-free rate, and then you divide by the asset's standard deviation. So what does that mean? Well, the numerator in the formula is referred to as the risk premium, and that's the premium that the asset is paying you to hold on to it. And since you're taking the expected return and subtracting the risk-free rate, if the risk premium is negative, that's an indication that you should likely choose another option. You can still choose to invest in that stock and it might work out for you. It's just that the math is indicating that the market has better investments available. And that's the same math that they're seeing on Wall Street, so just know that they will likely stay away from that investment, which can stunt market interest and price growth. You have to be careful betting against the math, because if the market starts to move against you, that type of pressure will make prices go down. So getting back to the Sharpe measure, because you're dividing the risk premium or the premium that you get for holding on to that stock by the standard deviation, or rather the stock's risk, what you end up with is referred to as the reward to volatility ratio, which is just a fancy way of saying how much reward you're getting for each unit of risk. And knowing that's what you're looking at, hopefully now you understand why this is one of Wall Street's favorite metrics. Trainer's measure is very similar to Sharpe's measure, except for you're dividing the risk premium by the asset's beta instead of its standard deviation. So by taking the risk premium and dividing it by beta, this metric shows you how much premium you get for each movement in the market. So now your analysis is linked to the market rather than the asset. And because of that, this metric is referred to as the reward to variability ratio, since it's linked to how much you make for each movement in the market. So both of these metrics are really interesting. I like Sharpe's measure to find good, stable investments that you know are performing well over a long time period. And Trainer's measure works really well in identifying stocks that are doing well during periods of volatility and growth. And if the market is growing a lot, it will help you identify those stocks that are typically the reason for it. So don't be intimidated by Trainer's Measure or Sharpe's Measure. A lot of people will stick to expected return or alpha to select their stocks, which we'll get more into alpha here in a moment. But Sharpe's Measure and Trainer's Measure are metrics that are very highly touted in the investment community, so learn how to leverage them for yourself and take advantage of what they're telling you. Getting into alpha. Alpha is really the metric that helps you understand the portion of an asset's return that's produced by the asset itself and not the market. Now, there are several ways to calculate alpha. The way that we coach is to take the expected return of the asset and subtract that from the product of beta and the expected return of the market. So when you take beta and you multiply it by the market's expected return, that tells you how much return the market produced. Then you subtract that from your asset's expected return to figure out how much of the total return was not explained by the market movements. In this particular instance, it's saying that 0.556% or most of the return is produced by the stock and not by the market. So this is kind of a unique example because this example only uses a few returns. Most of the time you are using longer return time periods. In this example, what the 0.556% is saying is that the majority of the return is due to the company's actions and not the markets. So alpha is a good measure for identifying stocks that are performing well during periods of growth and economic expansion. Stocks showing good alphas over 90 days or 1 year tend to be where you want to look if you're using this metric for stock selection. And in Portfolios 400, we get more into how each of the metrics performed in our testing and what the results say to do in order to get the best returns for each. The last metric we want to walk you through is our grade rank average. We actually tested a variety of different combinations of the other 4 metrics, and we even tested other common statistics to see if any of them were worth building grades for and including in the training. And I was surprised because the average ranking of the 4 metrics actually tested the best. So when I say average rankings, what do I mean? Well, it's the average of the rankings for each of the other 4 metrics. So we take the stock's ranking for expected return, alpha, Sharpe's measure, and Trainer's measure, which is just how the asset fell within the overall population for that metric, and we find the average rank. Then we take the averages and we re-rank them, and then apply the grading methodology to the new results. So in this example, out of about 11,000 stocks, this stock ranked 3,217 for expected return, 3,287 for alpha, 1,597 for Sharpe's measure, and 5,037 for Trainer's. Now, if you take all 4 of those and you add them together and you divide by 4, you come up with an average rank of 3,285. And when we do that for every asset in the population, and then we re-rank them to arrive at every asset's average rank, this particular asset came in with a ranking of 2,156, which when placed within the new grading scale, gave it a B+. So that's how we come up with the grade average. What we found in testing is that this is actually a really good blend of everything that works well. A stock that has a high grade for the average rank is one that has a great expected return, a great alpha, a high-performing Sharpe's measure, and Trainer's measure. And when you think about it, if you're performing well across all of those metrics, then you're going to find the best performing companies that are out there. And personally, I like to use one of the 4 main metrics for asset search, and then I always come back and reference the grade rank average to determine if the investment overall is a good investment and worthy of further consideration. The last topic I want to cover in this section is the return time period. This is in reference to the returns used to calculate your metrics and the historical time period that they cover. We tested a 90-day return, a 1-year return, a 5-year return, 8-year return, 10-year return, and a 15-year return. You can see the results here. The foundational metrics make up the red line on the chart, and on average, the 10-year return performed the best. And you can see in the table at the bottom that depending on the metric that you want to leverage for your strategy, the historical time period you want to reference can change. The model that we use to test this creates a pool of stocks based on the ones performing at the top for each metric. then it limits them down based on the level of risk that they're contributing to the portfolio. So these graphs are showing the performance of those portfolios, and you'll notice that some strategies have fairly high returns. We found that as we dialed in our testing methods, initially the computer would consider stocks with a very high beta, and it's easier for a computer model to stomach that kind of portfolio. Most individuals would not have made the selections that the system initially did, and as we honed in our process for later testing, we decided to make beta another limiting factor for including assets in our portfolios. And you'll notice that as you review the results in later testing, that the returns are much more realistic and reasonable. And we also publish what's in those portfolios in our reporting, so you can know exactly what stocks are behind that performance. Now, with our reporting, our goal is to help you know what's actually working and performing in today's market. So as you go to make decisions about your investments, you have good information available to you for reference.